I'm Charlotte McLeod with investingnews.com, and here today with me is John Reade, Senior Market Strategist at the World Gold Council. Thank you so much for being here. Great to have you.
Thank you, Charlotte. It's a pleasure.
Really good to be speaking with you. It's our first time talking, and I thought we could start with a little bit of a broad question just to set the stage here. So I'm going to begin with your thoughts on where gold is at in the current cycle.
Yeah, it's a good question, really, because, we're not far off all-time highs, and yet this would normally be a period where gold wouldn't be doing too well. I mean, obviously, interest rates are still high. The US dollar has been, until very recently, strong, but gold's performed really well. So coming up to what is widely expected to be the start of a US rate cutting cycle, ironically, you could actually say that gold is early in the cycle. Gold typically performs pretty well when rates are cut, and if those rate cuts lead to weakness of the US dollar, which they certainly might, then that could be a double tailwind helping the metal from here. So this cycle's been quite different, and that makes answering your question quite tricky.
Yeah, I think it has felt different to me as well, at least based on what I've heard about has happened in the past. So maybe we talk a little bit more about how we got here. And one of the elements that's been pushing gold prices higher is strong central bank buying, which I know that the World Gold Council is tracking closely. However, in the last couple of months, there's been some concern about the pause in Chinese buying. So I wanted to get your take there on central bank gold demand more broadly, as well as what's going on with China a little bit more specifically.
Well, you're quite right. Central bank purchases and the acceleration of those purchases that we've seen since the middle of 2022 have been a big factor in gold's strength. And yes, it is quite correct that the People's Bank of China reported no increases in its holdings in May, and nor has it increased its holdings since then, according to the data that they released to the IMF. So in some respects, you could say that that's a bit negative for the central bank story. But if you think about it, in the first half of this year, we saw record central bank purchases. The Q2 numbers were pretty good as well, and China was only buying for one of those months of the quarter. So I think it's fair to say that we've dialed back our expectations of central bank purchases a little bit this year, and that's mostly as a consequence of the lack of purchases reported by the People's Bank of China. But we're still expecting a high number for central bank purchases this year. Maybe not quite as high as we saw in 2022 and 2023, but almost certainly at a rate much higher than we've seen over the preceding 10 or 11 years. So I think that is certainly one of the factors that we're paying close attention to. We're waiting for the third quarter numbers to come out shortly. We should get those within the next, within the next 2 or 3 weeks. But even so, I'm not expecting a radical slowdown of central bank purchases.
I think the central bank angle is interesting to me because for a while I was hearing quite often that central banks are price agnostic when it comes to gold. They'll buy when they want to buy, no matter what the price is. But of course, so China has stopped buying as we've seen gold at all-time highs over the summer. So is there an element of maybe the price got a little bit high for them?
That could be one of the reasons. What we typically see with central banks when they're on an accumulation program, though, is that they make a strategic decision that they're going to increase their gold holdings and then hand over the execution of that to their reserve management departments, who have traders that are used to trading lots of different assets. So I wouldn't say they're price insensitive. The reserve managers are pretty good at not paying the highs in any move. But to me, the fact that the People's Bank of China has stopped for 4 months, that seems more like strategic rather than a recognition that the gold price is quite high.
The other element, so we have China buying, and aside from that, there's also the retail investor crowd in China and elsewhere in eastern parts of the world that's really picked up this year, helping support gold. And I'm wondering if we can look back at these summer months and what has that retail crowd been doing in the East? Because I don't know very much right now about what's been happening there.
Well, one of the interesting things about the lack of reported increases in holdings by the People's Bank of China is it seems to have deflated a little the demand for gold from investment onshore in China. I think there's a view that amongst the Chinese investors that they were buying an asset which was performing well, and they were buying an asset which the Chinese government recognized was performing well as well, and they were increasing their holdings in it. So I think that the move by the People's Bank of China may have deflated slightly the investment interest that we're seeing in China. It hasn't ground to a halt by any means, but certainly the strength that we were seeing in gold and gold demand earlier in the year in China has slowed down. More so in jewelry, I think, than investment, but certainly in investment as well.
The other point I wanted to bring up is you've written on Twitter recently, or I should call it X at this point, about COMEX managed money positions in gold futures and what that tells us about what's happening in the market. So I was hoping you could go into that a little bit, because I think it's an aspect of the market that people might not be as familiar with.
Sure. So look, all aspects of gold buying and selling are important to price formation. And even though over the course of a year, the speculators on COMEX probably don't change their positions very much, certainly over the long term, in the short term, they can move those positions around a lot. And one of the things that has contributed to the strength in gold that we've seen since the beginning of March has been increased investment and particularly speculative holdings on the COMEX futures market. Now, those positions over the last few weeks have got up to the highest levels that we've seen since before the COVID pandemic. And the structure of the gold market changed a little bit during the COVID pandemic for reasons probably too obscure to go into now. But certainly we think that there's a very strong likelihood that COMEX net managed money positions are pretty much as high as they are likely to get. Now, why is that? Part of that is because a lot of the investors and speculators on the COMEX market are trend following. They buy things when prices go up and keep going up and when momentum is strong. And that certainly has been the case in gold. Other aspects, though, that could have encouraged investment in gold is the anticipation of interest rate hikes. Sorry, the anticipation of interest rate cuts from the Fed, which obviously widely expected to happen in September. So on the basis that speculative and investment money in the futures market in the States is about as big as it can get, we may be lacking catalysts to take gold higher in the short term, even if the Fed does cut as expected this month.
Right. Okay. And I think we should definitely talk a little bit more about what's coming up with the Fed, because we have that September meeting that everyone's been watching coming up next week. So if you're looking at that, it feels like right now we know we're going to get a cut. It's been pretty clear. We're looking to see if it will be 25 or 50 basis points. Do you have any inclination in either direction there?
Well, I always say to people, you shouldn't come to the World Gold Council for your macroeconomic forecast. There's lots of organizations that have much more powerful economists than we do. My only thought on this has been for a long time is that, a 25 basis point cut is something that would make a nice, gentle introduction to an interest rate cutting cycle. 50 basis points to me would feel like almost that the Fed is admitting that it's late in cutting rates, or that things are deteriorating faster than expected. So I think you'd have to see something in the data that would really encourage them to cut by 50 basis points. Now, we've seen CPI out today, and CPI has come out perhaps a little bit higher than some commentators were expecting. And I've seen commentary on Twitter, which I still call it, by the way, that suggests that the 50 basis point cut is completely off the table now. So, and we've seen gold retreat slightly on the back of that slightly stronger than expected inflation data. So if you put a gun to my head as a personal view, I think 25 basis points is pretty much baked in now. I think the chances of a 50 basis point cut have receded, and we can see that from pricing in the interest rate futures market as well.
Okay. All right. Thanks. I don't think we'll put a gun to your head and make you hold to it, but thank you for going into that. So as you mentioned, we're waiting also to see what this will mean for gold. And earlier in the year, I was hearing from everybody, when the Fed makes that first cut, that's when gold is really going to take off. And then, of course, as you've been outlining, gold has already moved to all-time highs this year. So interesting to see what will happen there. If that is not the next leg higher for gold with this Fed rate cut, what could possibly be? Do you have any inclinations there?
Yeah, I'm not saying that the Fed cuts will be bad for gold at all. I just think that the market's positioned ahead of it. If you get away from the activity of short-term speculators, though, one of the things that should start to come into play is as interest rates diminish, not just on the one cut, but on what will probably be a series of cuts that will last for the next year or more potentially, is that one of the major barriers to investing in gold, particularly from a US perspective, will start to diminish. I mean, that barrier is the opportunity cost. When you can earn 5% in money market funds, then that's a barrier for people actually deploying money into gold. So I suspect that the series of interest rate cuts that we're going to see will probably be positive rather than just the one in September. We'll see this in a number of channels, I suspect, but the one I'm paying most attention to is in the changes in holdings by exchange traded funds, because ETF investors they've participated in this move higher in the gold price because they still hold large quantities of gold. But in general, over the last 3 years, they've been cutting back their holdings in gold at a relatively slow pace. There are signs that that's beginning to change. August marks the fourth consecutive month of relatively modest but inflows into global ETFs. So that's something interesting. We haven't seen that since the beginning of 2022, 4 consecutive months. But there is the potential, I think, for these inflows to continue and accelerate and to become a bigger part of the price formation of gold, something that they haven't been certainly positively contributing to that sustainably over the last few years. The other side of the market as well is the physical investment market for coins and small investment bars, which has fallen off a bit in the West, particularly in Western Europe, but also in the United States over the last 18 months. Again, lower interest rates will remove one barrier, which has caused that slowing in physical gold demand. So I think that's the thing that we're looking out for now.
Yeah, I was going to ask you about the Western element to the market because I'm hearing quite often, when are these people going to come back in? I think you already at least partially answered my question. I was going to ask you, historically, when do we see that Western interest come back? And it sounds like it's when we start getting into those lower rate environments. But is there anything else you would add on that note?
Yeah, I mean, recessions, crises, sudden changes, all of those things have prompted an acceleration of physical and speculative, but physical buying of gold from Western investors. I mean, the big change happened in the midst of the global financial crisis, and then COVID, and then to a degree the inflation that we saw as we came out of COVID. All of that boosted physical buying of coins and small investment bars, both in Western Europe and in North America. But as I say, things have slowed down. I mean, one of the things that strikes me at the moment is, yes, there is almost fairly clearly an economic slowdown taking place in North America, but it's not a surprise, and it's not panicking anybody yet. Of course, if that slowdown were to accelerate and turn into much increased fears of recession, then that probably would accelerate demand for gold, I would expect.
Are there any other elements in the gold market that you're watching carefully right now in terms of supply, demand, price drivers?
Well, everything really. I mean, one of the interesting trends we've seen over the last couple of years has been the strength of demand from emerging markets. We've already touched on this to a certain extent because the central bank buying is almost entirely emerging market buying. The jewelry strength that we've seen over the last couple of years, despite the increase in price, has been an emerging market phenomenon as well. We've also seen high net worth individuals, family offices, people that have got a lot of cash that are looking to protect themselves through investing in gold, really in ways that are quite different from, say, institutional investors or even retail investors in the West. So it's been an emerging market phenomenon, but there are signs now that that's slowing. We touched briefly before on China, more on the investment side, but the jewelry market has deteriorated quite a lot over the last few months. I was in Shanghai and Shenzhen about a month ago, speaking to some of the factories down in Shenzhen that make much of the jewelry for China, the biggest jewelry market in the world. And things have slowed down a lot, partly because of price, but partly because of the of a weak economy in China, particularly when it comes to consumer demand for all things. But so the interesting thing I would say is that gold has been able to ignore some of the classic macro drivers, the strength of the dollar, the high US interest rates, high European interest rates. But that may be changing now. As emerging markets are slowing somewhat and interest rates starting to come lower in the West, then we might see a reversion to what is typically seen as the driver of gold. So, slavishly following the US dollar and moves in interest rates and interest rate expectations. And it's one of the things that keeps the gold market interesting. So I joked before, yes, we look at everything because everything is important to gold, sometimes more or less so at any one time. I've spent a lot of time looking at emerging market trends in the last couple of years. Now I'm perhaps going back to becoming more of a US and European economic data follower than I was. The final thing I'd say, though, in terms of supply and demand trends, the slowdown we've seen in China has been partly offset by an acceleration that's taken place in India, the second largest market for jewelry. And the reason for that is that the Indian government, in a surprise announcement at the beginning of July, cut the import duty substantially. They took it down from, I think it was about 15% down to about 6%. So a 9% fall in the landed price of gold in India. And it happens to come at a great time as well. We're coming towards the end of the monsoon in India, into festivals and wedding seasons. That normally would be a strongish time for gold demand in India. This cut in the price, though, has really helped. And we're hearing that the Indian jewelry demand is really strong. So to a certain extent, that offsets the China story. But I'll reiterate, I think it's going to be Western macroeconomic factors that probably take the lead in determining gold's direction for the balance of this year and into 2025.
Right. I think definitely that makes a lot of sense. And as we're getting toward the end here, I'm not going to ask you for a price prediction because I know that's not what the World Gold Council is about. But I know that people are looking at the high prices and investors are always told they should buy low, but they also hear they need to protect themselves with gold. So in this environment, how can people balance those two things?
Look, it's always easy to talk with hindsight. The problem is when gold is low, people don't necessarily want to pay much attention to what you're saying. And of course, everybody gets excited near the highs. I take a long-term view. One of the charts I have in my presentation deck that I speak to investors or central banks about shows gold over the last 5 years, and it's more or less doubled in US dollar terms. But I also show one that dates back to 30 years. And, we saw gold at $250 an ounce, more or less, in 99 and 2001. And now we sit, at 10 times that level, more or less. So what does that tell you? It tells you that it's really hard to try and pick a level in gold in the short term. People should have gold in their portfolios. You can try and wait for markets to dip and come back to a level at which you feel comfortable about, but you may miss it out. And what I would say to people is that have a look at the constitution of your portfolio. Think about how much you've got invested in equities, in bonds, in other assets, and look to establish a position in gold. Somewhere between 5 and 10% is about the right level for most people. And if you're particularly bullish on gold, you can have more than that. In terms of picking the right price to get in, well, it's always going to be a tricky conversation to have, isn't it?
I agree. And I think that sounds like a good place to wrap it up, unless you had any final points or thoughts on gold that you wanted to leave investors with.
Yeah, I suppose the one thing I'd say is that there's an enormous amount of attention being paid to the US election at the moment by everybody, not just in financial markets. One of the things that I would say is, look, expect volatility as we go into the election and maybe after the result is declared, etc. So that could give people an opportunity to buy on dips, potentially, if we do get any. The second thing I say is I'm not really that bothered which candidate wins, because I think the main driving factor towards investment in gold in the medium terms, the next 5 to 10 years, is going to be growing concerns about the US deficit and the stock of debt outstanding. I don't think either party seems to have a credible plan to do anything to cut the US deficit. So from a gold perspective, I'm relatively agnostic to who wins, but I do recognize there's likely to be a fair amount of volatility in the run-up to the election. and in the days immediately following it as well. So just people to be cautious, not perhaps get too carried away one way or the other.
Okay, good to bring up, especially because we're all still probably digesting the debate. So thank you very much for coming on to talk about gold. Really good to have you on.
Thanks, Charlotte. It's been very good.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is John Reade with the World Gold Council. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.